In advance of the Illinois Real Estate Journal Multifamily Housing Conference on August 9th, we're here with Jeff Raday from McShane Construction Company to get his assessment on the state of the market. Jeff will be participating in that conference on the State of the Market panel. So Jeff, our question to you today is, what is the state of the market and what are the factors that are leading to those conditions?
Well, from our perspective, the market has been extremely strong for the last 18 months or so. On the market rate side of the apartment equation, affordable housing over the last 3 or 4 years has been extremely strong because of the availability of public money, Recovery Act money, which has since been used, HUD financed or HUD guaranteed loans, low-income housing tax credits. Those still exist and they're still being used. But a lot of the affordable housing work that we did over the last few years has begun to slow down a bit as those public money sources have begun to dry up. Good news is the market for market rate apartments has definitely taken the place and then some. So today it's more active than we've ever seen it as a company. We did our first residential project in 1998, so this is probably the strongest market for market rate apartments that we've seen as a company.
How long do you expect this boom period, if you want to call it that, to last?
That's a good question. I'd like to be able to predict that. In our industry, being able to look out much more than 18 months or so is pretty tough. But when we look at our forecast, we look at kind of the indicators for this market, we think we're good at least into 2014.
Great. Now, when you talk about this, are you talking about Chicago, or is that extend out throughout the Midwest and across the country?
Well, we're building multifamily nationwide. We've built in 22 states. A lot of heavy concentration in the Chicago and the Midwest area, and heavy concentration in the Southeast. But we're seeing it very active, pretty uniformly across the country. Phoenix, not so much right now, although that market is beginning to pick up speed.
If there were any drawbacks or reasons for concern for you, what would those be?
Well, like any real estate sector, I think our biggest concern is overbuilding. That's always a risk. I don't think that's going to be an issue, at least from our perspective, for some time to come. If you look at some of the forecasts that have been made on the need for rental housing in the U.S., the supply has dwindled dramatically. There's going to be a need for it for the next 10 years that it looks like developers aren't going to be able to keep up with. So not so concerned about overbuilding, perhaps in small pockets or small markets. Always the availability of capital. That's going to be the question, whether the money will be there to do it. And also if inflation begins to kick in. Right now we're seeing about a 2% per year increase in construction costs, which is pretty nominal. But depending on where the economy goes, if we do begin to experience some serious inflation and construction costs start to go up to the point where deals no longer pencil out from a first cost standpoint, then we could see some slowdown in that market.
Jeff, thank you very much for spending some time with us today.
Thank you.